Hello, welcome to Rebalance 34. This video will define and explain rebalancing, show why it's essential, and demonstrate how Rebalance 34 can help maximize returns on your savings. Before discussing rebalancing, we should say a few words about savings and investing. What is saving? There are those who will debate the wisdom of saving, especially when you're strapped for cash or when you're in debt. However, no matter how severe inflation might be or how tight your budget, if you can put some money aside, then, when you have an emergency, you can borrow from your own funds instead of having to borrow. Even if you're fortunate enough to be able to borrow from friends or relatives, borrowing money has consequences. If you're borrowing money from a lending institution, then part of the consequences will be the interest charged for using the lender's money. Most books on finance say that you should have the equivalent of 3 to 6 months of income set aside for those unexpected expenses. Most of us know that such a sum can melt like ice in the desert if your home or vehicle needs major repairs, or, worse yet, you should have a medical emergency. Yet, without such a cash cushion, you are at the mercy and the whims of chance. What is investing? Once you've set aside a liquid cash cushion, you are ready to save just a little bit more. The amount of money that you have over and above your periodic payments and above your emergency liquid cash fund is money that you can safely invest. Your emergency fund might reside in a savings account at an ordinary bank or at a credit union. It will earn a little money, perhaps 2% interest, but the returns will be extremely slow. The advantage of having money in a regular savings account is simply that you can make withdrawals from it without penalty. It is an investment of sorts, but it is one that brings very slow returns. Money that exceeds your daily needs and your emergency slush fund is surplus. Surplus can be used to purchase stocks, bonds, or similar interest-bearing depositories. The goal is for your hard-earned money to do some earning for you without the extreme effort involved when working at an hourly or salaried job, or even when engaged in entrepreneurship. What are the different asset types? There are 6 general investment types: cash, fixed investment, defensive investment, property, and digital property. Let's examine these investment types and how they relate to your personal or business savings and investments. Cash. Saving cash can range from keeping a change jar on the backside of your kitchen table to having a dedicated savings account at your local bank. As previously mentioned, this kind of savings or investment has value primarily as money that you can use when life hands you an extra sour lemon and you have to scramble to turn it into lemonade. Fixed interest. This is frequently a business or government bond. A treasury bill is a special type of bond that is secured by a government. It is a simple, easy sort of investment that is relatively secure. The disadvantages are that fixed interest investments lack the flexibility to maintain value in times of inflation or recession. Property. There are many kinds of property in which you can invest. This type of investment can range from small collectibles to gold, silver, or any precious metal or gem, or it can be real estate. Some types of property, such as collectibles or precious metals, can fluctuate in price as the market rises and falls. Rarity and potential for replacement will also affect the value of a particular asset, as well as desirability. The disadvantage of most property investments is that you must sell it in order to realize a profit from it. The exception to this is rental property, which, properly managed, should show a profit over and above maintenance expenses. These are also sometimes termed growth investments, because you hope their value to increase over time. Growth investments. These are usually company shares, although there are some other types of growth investments. The intent is that you will essentially lend your funds to a company and they will pay you a percentage return out of the company's profits. In some cases, you must sell your shares to realize value from them. Defensive investments. These are investments that pay out an income that is paid out regularly. These often include certain types of stocks and bonds. Sometimes they can be index funds, which is where a licensed broker will manage investments for a group, such as a worker union or company investment plan. Since your funds and those of the others in your fund group will be placed across a variety of investment types, these are usually low risk. Digital property. Digital property and digital cash is a relatively new concept, even though the general idea has been around since the late 1990s. Digital property can range from having use of a portion of a game or website in exchange, usually, for real-world cash. Game or digital properties can be traded or exchanged, usually inside a game context. However, websites, blogs, and similar assets might exist only online and still be organized in such a way as to generate income for their owner. Cryptocurrency, which can be earned or purchased using real-world money, is another type of property. Digital currency and cryptocurrency are similar, but not necessarily the same thing. Digital currency might be a medium of exchange that is only good inside a game for game objects. Cryptocurrency is a medium of exchange that can be used to purchase real-world objects or assets, or, for that matter, digital property. The big difference between cryptocurrencies and the money that you usually earn is that most real-world currency is backed by something tangible. Cryptocurrencies, although usually issued in limited runs, is not usually backed by any sort of tangible asset. That does not mean that a canny investor would not make money through use of cryptocurrency, but that lack of tangible backing is certainly something of which to be aware. Asset allocation. An asset is something of value that you possess. Allocation is the way you divide it. Therefore, asset allocation is the way the things of value are distributed across the different kinds of assets. Liquid assets. You might have some cash on hand for that emergency run to the grocery store, or a regular checking account for paying bills, or maybe a savings account for that all-important emergency slush fund. Those would be your liquid assets, or resources that you could use quickly at need. Investments are another kind of asset. They are usually part of your long-term planning for a secure future. Unfortunately, all investments carry a certain amount of risk. Even tangible assets such as real estate, silver, or gold are subject to market fluctuations. Their full value can usually only be realized by liquidating, that is, by selling them so that they turn into a cash asset that can be used. Even bonds, which are usually considered the most secure type of non-tangible investment, can be affected by inflation, recession, or depression. Changes in prevailing interest rates can create changes in their value as well. Stocks, which are usually considered to be the sort of investment that will have the highest return, carry a higher risk than bonds. Some types of stock, such as those designated as blue chip, are considered to be extremely stable and likely to give a steady, if unexciting, long-term return. Then, there are the highest risk sorts of investments. These might include penny stocks, day trading, or investing in a new business, to name a few. While the risks are greater for these sorts of investments, so are the returns. Encouraging growth while protecting your investment from loss. Smart asset allocation is a way to encourage growth in your investment portfolio while protecting your overall investments from excessive loss. This is called diversification. Diversification is essential to good investment planning. For example, let's say we have $10,000 to invest. Instead of putting all the money in stocks, we will buy $4,000 in stocks, $2,000 in an index fund, and $3,000 in bonds, and $500 in Bitcoin or other well-known cryptocurrency. This distribution will reduce the amount of risk to your investment funds. A typical investment distribution is 60% in stocks and index funds, with the remaining 40% in bonds. This way of dividing your investment provides opportunity for growth while minimizing the risk of loss. Typically 60% in stocks and index funds and 40% in bonds. Rebalancing. After a time, your investment portfolio might seem to reach a growth plateau and cease producing income for you, or it might be that you would like for it to grow a little faster. At this point, you might examine the allocation of funds and switch your investments around. This process is called rebalancing. A smart investor will check his or her portfolio periodically. This might be done at specific intervals, or it might be undertaken when there are specific economic indicators, such as the portfolio producing less than a certain percentage of growth. A rebalancing might occur when one asset type grows more than our asset allocation ratio. So we would sell a few shares of the asset that had performed well, using the result to buy a few additional shares of the asset that was low in value but that showed signs of future growth. This reduces the risk and gives some extra cushion to the lower asset type. In summary, this process is called rebalancing. Rebalancing typically occurs at the end of the quarter. Some prefer to do it at the end of the year, while still others like to rebalance their portfolio monthly. But rebalancing can also occur for other reasons. The Rebalance 34 is a rebalancing strategy. Rebalance 34 focuses on the idea that rebalancing should happen differently for each person's investment portfolio based on their initial investment amount, the invested date, and profit target level. This is a more meaningful determination of when rebalancing should occur. Rather than scheduling it at the end of a specific period or interval. Let's take an example of how this might work. Jane and Jake are both investors. Jane had an extra $10,000 on her budget on January 15, 2020, so she decided to invest, choosing the standard 60-40% ratio to split her total investment amount. So she bought $6,000 in stocks and $4,000 in bonds. This gave her stable growth through the following months. Jake did not have any extra money to invest in January 2020, but he was able to save a little money to invest in May of 2020. Since he was starting late and wanting quicker growth, he used an 80-20% ratio in stocks and bonds. He purchased $2,400 in stocks and invested only $600 in bonds around May 5, 2020. If their broker's rebalancing schedule is typical, both of these portfolios will be rebalanced on April 1, 2021, without regard to their individual portfolio performance. As Jake's portfolio grows, it definitely makes sense to rebalance on April 1, 2021. However, rather than until the next rebalancing date of July 1, 2021. Instead, if we do the rebalancing on April 25, 2021, Jane would take the best of her returns and minimize risk. Our goals in summary. Rebalance 34 uses the best market indicators and alerts to rebalance based on the individual initial investment, invested date, and today's market conditions based on personal criteria. To learn more, sign up for our website updates and social media announcements here. Investment risks. Any and all investments have underlying investment risk. Invest only the money you can afford to lose while planning to make that money grow. Remember, never invest mortgage or rent, education expense, grocery money, or monthly, quarterly, or yearly bill pay money. Acquiring investment funds. Slowly save a little from each paycheck or job. You might place your slow savings in a standard savings account at your bank or credit union. When you're starting your savings, you can make this a part of your emergency fund. When you have more than 6 months' income put away, use the surplus over that amount for investing. Saving up to invest can be a slow process. You might feel frustrated when others surge ahead of you in the investment race or when they have nicer things. But remember the old story about the tortoise and the hare. In the long run, it was the tortoise who won the race. Thank you. Happy investing.